ever feel like the world of investing has its own secret language?
It definitely can seem that way sometimes.
Yeah. Well, today we're cracking the code on something called an ETF. Might just be the key you've been looking for, you know. You're
Mm.
keen to get up to speed on this.
Mm-hmm.
And, well, our mission is to unpack the essentials of these exchange-traded funds
Right.
and maybe highlight why they can be particularly appealing if you're just starting your investment journey. So let's dive in. What exactly is an ETF?
Okay, so think of an ETF as like an instant portfolio you can get in just one trade.
An instant portfolio.
Yeah, it's a type of investment fund, right? And it bundles together a whole bunch of different assets, could be stocks, could be bonds,
Well,
and crucially, it trades on stock exchanges just like an individual stock would.
okay, so it holds lots of things but trades like one thing.
Exactly. It gives you diversification without you having to go out and buy, dozens or hundreds of different things separately.
Right, that sounds simpler. So it's a basket of investments treated like a stock. Sounds a bit like a mutual fund, maybe? But what's the key difference?
Good question. There are similarities, but the main difference, especially for you as an investor, is probably the trading flexibility.
Flexibility, how so?
Well, ETFs, you can buy and sell them all through the trading day, just like stocks, at whatever the market price is at that moment.
Ah, okay.
Mutual funds, though, they're usually different. You typically only buy or sell them once a day at the end of the day based on their net asset value.
So the NAV, the sort of underlying value calculation.
Precisely. So with ETFs, you get that real-time trading ability.
Got it. So being able to trade during the day is a big plus. What else makes ETFs appealing for someone, just starting out?
Well, often the barrier to entry is lower. ETFs can have lower initial investment amounts because you can usually just buy a single share if you want to.
Oh, right. Not like some funds where you need a few thousand to start.
Exactly. Plus, because they trade like stocks, the whole process might just feel a bit more familiar if you've ever looked at stock trading before.
Okay. Yeah, that makes sense. You mentioned trading during the day. That's intraday trading, isn't it? What does that really mean in the context of ETFs?
Yep, that's the term. Intraday trading just means buying and selling shares, in this case, ETF shares, within the same trading day.
And the price moves around.
It does. ETF prices can fluctuate throughout the day based on the value of the assets they hold and general market conditions.
So you could react quickly if something happens.
You could. It allows for timely reactions to market shifts. But a word of caution for beginners. Frequent trading takes a lot of market understanding.
Right. And probably cost more in commissions, too.
Can do, yeah. Honestly, for most people starting out, focusing on longer-term investing with ETFs is probably a more prudent approach.
Makes sense. Stick to the plan. Now, one of the really big draws you mentioned is instant diversification. How does that work? Sounds almost too easy.
It's actually one of the most powerful aspects. Think about it. A single ETF can give you exposure to a huge slice of the market.
Like how huge?
Well, take an S&P 500 ETF, for example. One share effectively gives you a tiny piece of 500 of the biggest companies in the U.S.
Wow, okay. So you're spread out immediately.
Instantly. And that diversification helps lower your overall risk compared to just putting all your money into, say, 2 or 3 individual stocks.
Yeah, that definitely sounds less daunting than trying to pick individual winners yourself.
No.
But what about those ETFs that focus on specific things, like tech stocks or maybe clean energy?
Yes. Sector or thematic ETFs. They exist, and they let you target specific areas you believe in.
But I sense a but.
Yeah. They inherently carry more risk because they're less diversified. If that specific sector, like tech, takes a downturn, that ETF is likely going down with it quite hard.
So less spread out means more potential for big swings, up or down.
Exactly. For beginners, it's generally wiser to start with those broad market ETFs, get your feet wet, and then maybe explore sectors once you understand the market better.
Good advice. Start broad. Now, another term you hear is liquidity. What's that about with ETFs?
Liquidity is basically how easily you can buy or sell an asset without causing a big change in its price.
So, are there always buyers and sellers available?
Pretty much, yeah. For ETFs that track really popular large indexes like the S&P 500, again, there's usually very high liquidity, lots of trading activity. Makes it easy to get in and out when you want to.
Okay, easy in, easy out. That's important.
Yeah.
What about costs? Are there fees involved?
Yes, there are. The main one to look for is the expense ratio.
Expense ratio.
It's an annual fee expressed as a percentage of your investment. It covers the fund's operating costs, management, admin, that sort of thing.
Are they high?
Generally, ETFs, especially passive index ones, have pretty low expense ratios compared to many actively managed mutual funds. But it's always smart to compare them before you invest. Every little bit counts over time.
Right, check the fees. And what happens if the companies inside the ETF pay out dividends? Do you get those?
You do. The ETF typically collects all the dividends paid out by the stocks it holds.
And then?
And then it usually distributes that income to you, the ETF shareholder, often on a quarterly basis. You might get it as cash, or often you can choose to automatically reinvest it back into more shares of the ETF.
Okay, so you get the dividend benefit too.
Right.
One last thing I've heard about leveraged and inverse ETFs. They sound intense.
Mhm.
Should beginners even glance at those?
Oh, absolutely not. Steer well clear.
Really? That's strong a warning.
Definitely. Leveraged and inverse ETFs are complex financial instruments. They use derivatives and debt to try and amplify returns or bet against the market in the case of inverse ones.
Amplify losses too, presumably.
Exactly. They are designed for very sophisticated traders, usually for very short-term bets, and they come with significantly higher risk. They're really not suitable for beginners or, frankly, for most long-term investors.
Got it. Avoid those. So, wrapping up, ETFs sound like a really user-friendly way to get started with investing, especially with that diversification built right in.
I think that's a fair summary, yes. What's quite fascinating is how they've made diversification so accessible for everyone. One trade, broad exposure.
Yeah.
And that kind of raises an interesting thought for you, the listener. Now that you have a better handle on ETFs, what specific areas of the market might you be curious to explore through them, perhaps as your knowledge grows down the line?
Hmm.
Or maybe just consider how that ability to diversify so easily with just one trade could fit into your bigger picture financial goals.
Definitely some interesting things to think about there. Food for thought.
Oh, no.
Well, here's to continued learning in the world of finance.